we'll just get started with that. Oh man, before we get too into it and we get started, anybody here love paying taxes? Anybody feel like they're getting their money's worth when they pay taxes? Maybe Spencer. I don't know. He decided he doesn't pay any. I don't either. And yeah, taxes are essential to keep the country running. That's how we've chosen to pay for things like military and fire and police, right? But I think we pay too much. And if we can find a way to pay as little as possible legally, that's a good thing, right? Also, if we can find a way to pay as little as possible and qualify for a great mortgage as a self-employed person, even better. I'll talk about that in depth. But let's get started here. Okay. I think I might have to do that so I can see. Is sound going to work? I don't know. Oh, it doesn't. Can I borrow that microphone? I'll just shove it into my speaker here. I don't know. I got you.
Didn't I just tell you to save your money?
You read the subtitles. Sorry.
Work is paying for it. Work is paying for your bedding.
I was Italy, but now I don't want to.
What is that? Is that a new plan? Yeah. I'm thinking of bringing homeware into the store, so that's a write-off. That's a write-off? Do you even know what a write-off is?
Yeah. It's when you buy something for your business and the government gives you that for it.
Oh, okay. Thanks for it. Okay. Who writes it off? I don't know. The write-off people. Why are we having this conversation?
So if I need boost to get through my day, I can write it off.
What skincare products you purchase? Skincare products?
I have the face.
What does that say about the legitimacy of the store? That's not a write-off. That's not a write-off. This is not a write-off. David, a write-off is a business expense used to reduce your taxable income. Well, then why is it called a tax write-off? It is! Yes! You can't just buy things for yourself and write them off.
Well, then I'll return some things.
Not enough space in here for the massage chair.
I should get back to work, just in case any other packages arrive.
Okay, all right. We love that. That's fun. It's hard to see this, but yeah, okay. All right. I don't know. We can have this. I can hear that a lot better than what's on the microphone. Okay. Good to know. Okay. So just a little bit about me first. I've been a CPA for over 10 years now, and I specialize in real estate tax strategy and real estate agents. Over 90% of my clients are investors or agents, and often both. And I'll tell you about how amazing it is to invest in your own product. From a tax perspective, if you don't understand from an investor perspective, it's awesome on taxes too. So if you guys have been to CE classes before, if you guys have deals catch on fire, just be discreet about it, right? Keep questions general. The tax code, if you stacked it up with paper on top of paper, it'd be 3 stories high. And so if you ask me a question during this class, like, hey, my aunt owns a 1/3 share in a charitable remainder trust, and she wants to do, that's probably appointment level material, right? So try to keep your questions related to the rest of the class, right? Good. It's also real easy to get political when we're talking about taxes. That's not the point of this class, obviously. You can go on social media if you want politics. Don't go here, right? So try to avoid politics. Feedback is awesome. I do change this class based on what people want to hear and what people feel like they're missing or they really liked. So I do appreciate that. Objectives. So we want to understand the value of legally taking advantage of tax laws and penalties for errors, whether they're intentional or not. Why and how to avoid an IRS audit. I hope the why is pretty inherent, honestly. and how to choose a great tax pro. Entity selection, anybody ever have the question, should I do an LLC or an S Corp? I'm going to answer that one pretty thoroughly. And why? Deductions and credits, walk the line, hey, what can we write off, what can't we, what's a credit, what's a deduction? We're going to go there, right? What to keep track of, a little bit, huge advantages for real estate investors. I have started to construct a class only on that. There's some bonkers moves you can do as a real estate investor, especially as a real estate professional like you guys. Tax strategy with reverse mortgages. Yeah, if you're sour on reverse mortgages, I strongly urge you to change your mind. They're freaking fantastic in the right hands. And there's a cool tax strategy you can use I'll show you about. Qualifying for a mortgage while self-employed. Anybody tried to buy a house when you guys are all self-employed, right? Extra fun, isn't it? Tax returns are involved. All right, so why are taxes such a hot topic? Well, anybody in here never been a W-2 employee? Pretty much everybody. I got one back there. All right, self-starter from birth. Awesome, I love it. So, when you're a W-2 employee, if you do your W-4 right, your taxes are taken out before it hits your bank account, right? You see it on your pay stub, and you might be an M a little bit, like, oh man, I had to pay that. But it didn't hit your bank account first. When you are self-employed, the money hits your account first, and then you have to turn around and give it back. That hurts a little bit more, doesn't it? Not only that, but if you do it suboptimally and you're self-employed, you'll get hit harder. You'll actually pay higher taxes than somebody who is a W-2 employee if you're doing it wrong. Anybody in here who had, hey, I got my real estate agent license my first year, I don't know, I made $40,000. It was my first year, just trying to lift off. Then the next year, somewhere on there, I busted off and I made $120,000, and then you get your tax bill and it's walloped to you. That ever happen to anybody? All the freaking time. I see that all the time, especially if you're doing your own taxes. Okay? Also, this fun thing. I kind of have a love-hate relationship with social media. I hate it because there's so much misinformation spread on social media, right? And the way social media is designed isn't, hey, this person is an expert, so we're going to boost their content and put it in front of more people. How do you get in front of more people on social media?
People like you.
Yeah, being entertained.
You entertain them, right? It doesn't matter if you're an expert. The most distinguished experts I know in taxes, they don't even have Facebook accounts to Instagram, right? They just run their thing. The loudest and most entertaining people are the ones usually featured on things like that. So I love it because it drives people to ask questions to their tax professional. So a little tongue in cheek there. And also it's really fun. A lot of them make it seem like nobody pays taxes. There are ways to not pay taxes. It's true. Sometimes you got to just figure out if the juice is worth the squeeze, right? Common audit triggers for realtors. My gosh. Not reporting income that another entity reports. What did you guys just get? Maybe about a month ago. 1099. What did the government get? A copy of that 1099. So if you report less revenue or GCI than your 1099 got from your broker, that's almost automatic. You're going to get a letter from the IRS. That's computerized, okay? And the reason they send one is because they want to, legitimize that they spent that money on commissions for their realtors. They can write that off, right? Okay, so significant inconsistencies in bucking standards. Who here had a very different year in 2021 and 2022? That's it, like 4 people? Liars. Now, I'm not saying that having inconsistencies or having, wild swings is necessarily a bad thing. Business happens, right? 2021, 2022. Like, it's been weird years. People who lived through or working through 2006 through 2008 saw massive shifts, right? The thing is, the IRS receives over 1 million tax returns from people who say, yes, I'm a realtor. So they have a pretty dang good idea about what expenses and what expense ratios, this person spent X amount of dollars and X percent of advertising. They have that data for you. And if you're wildly off, it doesn't, this profession is a little more volatile than most. But if you're wildly off, it could have, some effect to a human looking at it. Most of these are processed by computers, right? That being said, if you're reporting accurately what you're actually doing, you have nothing to fear, like really. So Yeah, making expense. Here's where I tell a story where in one of my previous offices, we had a client. It was my partner's actually. We had a real estate agent from California, and they made like $400,000 in GCI, pretty dang good. And they spent $200,000 on Google and Meta ads. Okay, that was their way of getting business. It worked for them rather well, right? 200K, California's a little different than 200K here, but you guys get the idea. We told this person, or he told this person, hey, your chances of being audited are sky high. It is exceptionally odd for a real estate agent to spend $200,000 on advertising. Can you back this up? Like, yes, every penny. We have every receipt, every invoice. Right, we filed it. Sure enough, he was audited, and in a rare circumstance, no changes, no suggestions. So, not saying like don't claim your stuff, but if it's wildly off and highly unusual, you might have a human IRS agent look at it. Okay? Using lots of round numbers. Hey, I had advertising expense of $10,000, 000. I had 20,000 business miles, 000. What does it look like you're doing? Making it up. Guess what the IRS doesn't want you to do? Yeah, make it up, right? So, high travel, mileage, and meals expenses, those are the most commonly audited things for small businesses. Like, yeah, I'm going to write off my family vacation, the entire thing to whatever. And I promise it's a business trip because I, quote, looked at houses. I'll talk about that when I talk about travel, because there's ways to do things like that. Or, yeah, mileage. Yeah, every mile is a business mile because I have my logo on it, right? Unfortunately, no. The purpose of the trip determines what's a business mile. And meals, of course. So I'll get into all those in detail in further slides. Okay, other odd triggers that aren't specific to realtors necessarily. We have net operating losses year after year after year after year. If you're doing that, the IRS might wonder how you are alive. And claiming all these losses, or they'll say, hey, this looks more like a hobby. Anybody hear of hobby loss rules before? It looks like a hobby. You're just trying to write off your camera because you have a, quote, photography business or a travel agency, right? If you have losses year after year after year, you don't have, the IRS doesn't think you have a business. Now, if those are legit and just have hard times, like, they get it. If you can back it up, great. Okay? Self-employment mildly raises the audit risk. Not terribly high, but none of this is guaranteed, obviously. Heavy use of tax credits, especially ones like the fuel credit, which are very, very specialized. That can get audited sometimes. Claiming specialized status like real estate professional status, if you don't have the documentation, that can raise your risk. S-Corp's not doing payroll. IRS is really starting to crack down on that. You got to get your quarterlies in. Okay, we'll talk about that when we talk about S-Corps. How do you choose a tax pro? So in your interview, you can talk about, this is probably the biggest one. What do you specialize in? I would be shocked if all of you haven't been beaten to death with the term avatar. Right? What's your unique value proposition? What's your niche? That's a really powerful thing, right? So if you have a professional and you want to have somebody in that niche, right? Because there's a lot of special rules in real estate. It's like, don't ask me to do a farm or a nonprofit. I'm not the best professional for that, right? So you want to ask them about that. How do you communicate with clients? Typical response times. It's going to be different during this time of year than it is in July, say, probably, right? Some red flags for tax preparers. No credentials. Did you know you don't even have to have a high school diploma to get a preparer tax ID number? No. That's crazy. Isn't that bananas? I got a master's degree. I'm just saying, whatever. but there's some credentials out there that are excellent. Enrolled agent is one of them. I know some enrolled agents who are like top of their field. They don't care about CPA. They don't have to. Awesome. Refund loans. I would call that a yellow flag, really, where, hey, based on what you're going to get for a refund, I'm going to give you a loan for that. Guess what the interest rate on those is? It's like 36, 37% on those. Hey, give me a refund or give me a loan for these, 3 months while I wait for my refund. Careful. Not signing return. This is the biggest red flag up here. You get your return back and there's nothing in the paid preparer box. Run. Don't walk. Refund-based fees. So if someone's preparing your tax return and they say, hey, I'm going to charge you, $3,000 if I get you a $10,000 refund. But if your refund is lower than that, say it's $5,000, I'm only going to charge you $1,000. That is highly illegal. Okay, that's not allowed. That would incentivize you and me to commit fraud. That's why the IRS doesn't like that. Okay. Okay, so who is responsible for the tax return? It rhymes with goo. You. Your tax preparer is not an auditor, for example. We're going to provide guidance, but the most important signature on that return is going to be yours. Yes, we can be liable if we're fraudulently and knowingly committing fraud on your tax return. We can be held liable for that. But so will you be. It's crazy that they have this giant stack of the tax code, and you're supposed to yep, he did it right, I guess. You know, I find it weird that my job even exists. The tax code is so complicated. Anyway, when there's always one every year. Here's a box of receipts. Do my taxes. You want me to? I'll do your dry cleaning for $450 an hour if you want. I'll run that. So the more organized you are, the better it's going to be for your costs and also for the taxpayer. It's going to be a lot more accurate. That being said, if I see your profit and loss statement for your real estate business, for example, I'm not going to ask you, okay, I want to see all your receipts for this travel expense. I don't believe you. I don't have time for that. Now, if I see something extraordinarily high, like my old partner did when he's like, hey, $200,000 in advertising, I might ask a question, but I'm not going to ask for invoices almost ever. I don't have time for that. Right? There's a lot of trust we're putting in you. Okay, did you track your hours for your real estate professional status? If you're doing that, or I don't have time to check on that. Usually, if you want to, you can probably pay us extra for that. But we're not going to audit you, right? All right. Any questions on audits, tax preparers, how it works? For that?
Do you have to actually have paper receipts?
Do you have to actually have paper receipts? Ooh, that's, I don't have a slide on that, so I'll just answer that now. You don't have to have paper receipts. A lot of mine are digital. The way I keep track of my receipts, everybody have a camera phone here? Anybody not? That would be weird. You just take a picture of the receipt, store it in a folder called March 2026 Expenses. Cool, you have a copy of the receipt, good enough. You don't have to put it in the proverbial shoebox. Make sure it's backed up on the cloud. 7 years, if you want full protection on that. I know. So, good question. Are we ready to move on to entity selection? S Corp or LLC or partnership or C Corp or any of that?
Can I ask you a quick question?
Of course.
If we're full-time realtors, do we have to track real estate professional status hours?
If we're a full-time real estate agent, do we have to track real estate professional hours? Probably not. If that's the only thing on your tax return for that individual, you're fine. Now, if you have a W-2 and it's got, mid 5 figures on there, you probably will, because that's frequently audited. So, okay. So entity selection, LLC versus S Corp. It's not LLC or S Corp. It's LLC filing as an S Corp or not. You still have an LLC if you got an S Corp. You could also incorporate, but that's uncommon. For now, we'll just talk about LLCs. That's good enough for you guys, for sure. Okay, you have an LLC filing as an S Corp. If you don't make that election, you're probably filing as a sole proprietor. If there's more than one owner, you're filing as a partnership by default. You could file as a C Corp. There are very limited use cases for that when I like C Corps over these other ones. For almost every real estate agent, I highly prefer S Corp if you're making enough money. Okay? Because C Corp, there's a risk of double taxation there. There's a special use for that. There's a few of them, but for all intents and purposes, I like S Corps for most real estate agents. Save you the most money. Okay? So it's not one of those, it's filing as that. Now there's all kinds of entities. I'll talk about that a little bit as far as LLC and such, but P stands for professional. You can get that in Utah if you want to. You guys have professional licenses. You're dealing with high dollar transactions. I think in Utah you're fine with an LLC. You don't have to switch to a PLLC if you don't want to. I don't really encourage that necessarily. Like law firms and some accounting firms are PCs, professional corporations or PLLCs. Anyway. All right. Business bank accounts. I don't use AI very much in marketing because I think, I'd rather type the stuff out myself. But sometimes I'll let it draw pictures because I can't even color in the lines. And this is one of those instances. So sorry, not sorry. Get a business bank account. When you get your LLC, they're going to give you an EIN. That usually lets you go open a business bank account. You can get bank accounts without an EIN, but this is the best way to keep what's called your corporate veil intact. Okay? Speaking of corporate veil, if you are sued, anybody know about what an LLC does for you? Just in general terms? Right in the back.
So when you get sued, they can only go after a company asset and not go after your personal. So if you have your car as your personal property, they can't take away your car for recouping costs for the lawsuit.
Generally, yes. Yeah, if you are acting in a professional capacity as a real estate agent doing real estate things and you get sued while you're doing those things, theoretically, they're not supposed to go after your personal assets, your personal bank account, your house. Okay, now if you're driving business miles and you're doing that, then they could go after your car because that was part of the thing, right? But generally speaking, it protects your personal assets from business liability. Okay, pretty good deal. Clear financial separation when you have a business bank account. It's also really easy to do your bookkeeping. If you have them mixed in with your personal bank account and you're just trying to do expenses and trying to pick out, it's a pain in the butt, right? Goodness. So, entity selection, limited liability company. That was a great summary back here. So, it does protect your personal assets from business liability. So, let's say you're at an open house and you get in a fist fight with somebody there. Right, real professional behavior, right? But you do, they punch, they sue you because you put them in the hospital because you won the fight. And they sue you, and there's, I'm not a lawyer, right? But they're supposed to only go after your business assets, okay? It doesn't go the other way around, by the way. So if you're acting in a personal manner, like you go to a Super Bowl party at the bar and you get in a fight there, they can actually go after you, and they sue you. They can actually go after your LLC because that is one of your personal assets. There's ways around that called a COPE, but that's beyond the scope of this course. That's a little more relevant when you have a couple commas in your net wealth. LLCs are business structures recognized by state statute. LLCs really aren't recognized by the IRS in a major way. Okay, so having an LLC doesn't unlock extra tax benefits. The only one it does, and why I have this funny meme here, I like memes. Why I have this meme here is it does enable the S corp election. Okay, but having an LLC doesn't mean you can start writing off stuff that you couldn't before. You don't have to have an LLC to have business expenses. Okay, I think you all should because you have professional licenses. It's a really good idea. But an LLC doesn't unlock special tax benefits except for S corp status. Okay, some types of businesses aren't allowed to be LLCs. Default tax structure. Sole proprietor if you're single, multiple members as a partnership, and you can elect to be taxed as a different classification, like an S corp. Okay? Anybody hear about, hey, you should have a Wyoming LLC or a Nevada LLC instead of a Utah one? Am I about to break some boxes by telling you don't do a Wyoming one yet? Don't do a Wyoming one for your operating business. That's a great asset protection stuff for personal reasons if you have your revocable living trust, but your operating business should be where your head hits your pillow at night in Utah. Otherwise, you have to register in Utah as a foreign entity. I know that sounds weird because it sounds like foreign country. They mean foreign state. But for your operating business, you should have your LLC domiciled in the state where you are doing your business. Okay, there's payroll stuff in there. By the way, if you're sued and you don't have your LLC registered in the state where you're operating business, you don't have an LLC in that state. They can go after your personal stuff. So be careful with your Wyoming LLC. There's a place for it, but for your operating company, have it in Utah. I'm assuming you guys are all from Utah here. So, I've seen some weird stuff happen there. Okay? So, sole proprietorship, that's the default when you have a single member LLC, right? It's okay for net profits up to $40,000 or $50,000. I'll get into why in detail here, but it's okay. The biggest difference between that and other entities, you're going to have self-employment taxes. I can't tell you how many times I've seen higher self-employment taxes than income taxes for go. Sorry. Sorry. Like I said, you don't have to have an LLC to have a sole proprietorship. You could have no business entity at all. If your son or daughter wants to go mow lawns, just to make some extra summer cash. They don't need to go to the state of Utah like, hey, I need an LLC for Dan's lawn mowing. Like, just go do it. I mean, the LLC is there to protect you from being sued, and who's going to sue the neighbor kid down the street? You know? Even for you guys, if you're starting out a business, you just want to see if it works, you don't have to get an LLC set up for it. You can just start a business. Hey, I like this. Let's keep it going. Yeah, let's think about some of these other steps. Okay? All right, so let's talk about self-employment taxes. Big, bad, they're awful. Okay, so again, for W-2 wage earners, the employer pays half, and you pay half as a W-2 earner. Okay, when you're self-employed, you pay both halves. Ouch, right? Goodness. Only income in 2026 up to $184,500 is subject to Social Security taxes. That's the lion's share of that. It's 12.9% of this 15.3. On Medicare taxes, there's no limit to that. You'll have an extra 2.9 or 2 point whatever percent. I don't know. I'm actually not good at quick math in my head, believe it or not. I have tools to do that, but the remainder of that is going to be Medicare, and that will be every dollar you make if you're self-employed and you don't have an S corp. Okay, every dollar is going to have an extra 2.9%, or 2.4. Okay, so we'll talk about those in a second. I'll actually show you some numbers around this, and don't worry, you don't have to do math. I'm going to do that for you. My spreadsheet's going to do it. I just told you I'm not good at math. Quick math. Anyway, so an S corp. Here's the letter S. So income taxes, the S corp itself isn't taxed, like it's not an entity that has taxes. All the tax affecting the income is passed down through the owners. It's called a pass-through entity, or sometimes a disregarded entity as well. But employment taxes are still due, but only on the reasonable salary portion. Okay, and usually that reasonable salary is going to be, roughly 20 to 50%. I like to say of distributions, meaning the money you take out of your business. And I'll do some math on it in a second. They start to look pretty good, like a pretty good idea when you've reached 40 or 50,000 net profits. Okay, not GCI, because you have expenses. This is your income minus your expenses is your net profit. So once you have a net profit around 40 to 50K, I'm going to start having conversations with you about having an S corp. And let me just show you why, because it's probably easier. One of your handouts, by the way, has those. It's what's it called? 2026. Should I file as an S corp? Okay, that one. Oh, I didn't like that. Well, see if I can stretch this a little bit.
If you still need one, you can raise your hand. Oh, well.
I brought 60 of them. I don't know. It should be enough.
We can wait.
Is it that? Yes. Okay. Now I can do math and see here. All right. So should I file as an S corp? This is mostly all the blue ones, and that QR code is so you can run your own scenario if you want to. I'm not going to ask for volunteers because you have to tell me how much money you make in front of the whole group. But I'll just do some examples. I think this is the one that's on your handout. We have net GCI here, or net commissions, 150K. We have expenses of 35. And for this purpose, we're assigning a 40% of your net profits to be your reasonable salary. And remember, I said you're only going to pay self-employment taxes on your reasonable salary. Why don't we put that at 0? It's not reasonable. Yes. The IRS is starting to crack down on reasonable salary quite a bit too. So somebody who's an escrow, I'm making $300,000 net profit, and my salary is $2,000 a month, $24,000 a year. Probably not reasonable, right? Goodness. Now there's scale, and don't try to do this yourself. This is an exercise you do with your accountant. Okay, like, hey, I'm just going to decide that I want to put 40,000 there, and that's going to be it. Like, no, you have to have a discussion with that. You want to say in the guidelines. Too high, and you're paying too much in taxes. Too low, you got 3-letter agencies after you. We don't want that, right? Okay, so we have 150,000. Let's say 35, and I know I told you not to do round numbers, but this is an example, right? So salary, we put in 40% there. That's salary of 46 on this one. Your net profit's 115. That sounds pretty reasonable for this case. Then you have preparer fees. These aren't mine, by the way. They're fairly close, but you can put whatever you want in here. This is customizable when you're ready. Notice you have to do payroll. Do I have to do payroll when I have an S corp? Yes, you do. Yes, you do. Yes, you do. Okay, so you see the biggest difference here is the self-employment. That's why I have it highlighted in orange. You're still going to have income taxes on your profit. There's no way around that. That's just how the world works. However, your self-employment taxes, look at this, at $115,000, your self-employment taxes is higher than your net income taxes. Isn't that bonkers? Anyway, this is how we do something about that. We have an S corp. We pay a lot less in those self-employment taxes. So, because S corps aren't free, like you probably have to, if you don't know what you're doing, you should hire somebody to do your S corp for you. Unless you're really confident, fine. But it's a little more expensive because they got to do an S corp return and a personal return, right? So, after those costs, like if you're going to pay me more or your accountant more than you're going to save in taxes, that's not very smart, is it? So that's why I like to see 40 or 50,000. That's one reason I like to see 40 or 50,000 as a threshold to where we start thinking about having an S corp. Okay, so you got to pay your accountant a little more to do this. So after all those costs, we're going to save around $8,600. Is that worth it? I don't know. It could be. Depends on. So there's a little extra you have to do. You got to stay on top of your bookkeeping a little more. And you have to do payroll and quarterly filings. You can pay somebody to do that, of course, but it's not just like, hey, let's flip a switch and we're done. Okay? That juice is probably worth a squeeze for most people, but not for everybody. Depends on what you want to do. So let's run another scenario here to where it won't make sense, or where it barely makes sense, and why I don't love that. So let's say they made $50,000 in DCI and they still spent $35,000. Okay? You're going to show a loss. You're going to pay me more than you're going to save in taxes. Okay? Now, even if you're right at the threshold, let's go 75,000. Hey, you're still going to save, that's $40,000 in net profit there. You're still going to save $1,700 after you pay your accountant. However, there's hoops to jump through. And I'll talk about in my next slide about when not to just do it, because it's a multi-year decision. Don't just base it on 1 year. Okay? Any questions? You want me to run a scenario here? Yeah.
I was just curious, for this income net profit, you're at about 40% for salary versus net profits. As income rises, is 50% your cap for salary, or would you suggest more?
As income rises, generally the percentage goes down, in my book, with everything I've studied.
So 50 or less.
Yeah, generally. Often less. I mean, really high income, that might be down to 10%. It also depends on how much you're working in the business, right? If you're very part-time, let's say it's not real estate, because it's hard to do well in real estate part-time. It's not impossible. But we had a software company owner who he had built his systems and profits so well that his team could run the whole thing. He worked like 10 hours a month. Awesome, what a dream. Because he didn't work very many hours, we pushed his salary down to like 5% of his net profits. And it was okay, it was super defensible. So it really depends. This isn't just something you just, hey, accountant, I want this. Like you do that as a team sport. But it's a great question. Yeah, it's not a fixed percentage. It really depends on everybody's situation. Okay? Any other questions about S corps? Somebody give me a drink of water, please. That would be great. I'll try and pull it here. Thank you so much. Okay. So do we understand S corps a little bit better now and why we do those? Thank you so much. That would be great. Yeah, question.
Does an S corp help you with like other sources of income?
Like, does it help you with other sources of income, like investments or anything like that?
Oh, well, I'll talk about why you should never hold investment properties in an S corp, except for flips.
Okay.
But yeah, an S corp is almost all about self-employment taxes, and there's no self-employment taxes on rental properties, so there's no reason to have it. In fact, there's some huge negatives to putting in an S corp, and I'll talk about those in a minute.
Okay, yeah, because the concern I've been having is like capital gains and all that.
Yeah, S corp is terrible for capital gains for hard assets like real estate. Ooh, yeah. I'll get there. One other perk of filing as an S corp, you have a lot lower chance of being audited. I don't know why. I think the IRS has come to the determination that, hey, if somebody knows enough about the tax code to file an S corp, they probably have some pretty good guidance. They're going to look for your officer compensation, your W-2, your reasonable salary, and if it's good enough, I mean, you have a lot lower chance of an audit, like 10 times lower chance of an audit. So, kind of nice perk. When it is a bad idea, I mean, obviously, if your income doesn't justify it, right? It shouldn't be based on only current year tax savings, right? So if you got to 50,000 and it was kind of lucky, and you don't know, or you're winding down, or you're retiring, whatever, you're just done, and you made it on a fluke a little bit, and you're really not sure if that's going to happen again next year, don't file your S election. Anybody know why? Once you file your S election, how long do you have if you take it away? I'm asking advanced tax questions. So if you file as your if you make your S election for your LLC and you decide, hey, this isn't worth it, I'm paying too much for it versus the tax benefit, you can revoke that S election, but you can't have it back for 5 years. That's why. So if you say, hey, I'm going to start a new LLC, like they're on to you, like they see your tax return. So just don't make this based on 1 year's income. If your business is on the upswing and you made 50K and you're up there, awesome, let's go. Love it. Okay, because there's more stuff to do. You got to stay on top of your bookkeeping more too. Okay, you got to have a little more financial discipline. So this is something, I met somebody last year who I talked out of having an S corp, even though they made $100,000 in net profits, because they were terrible savers. What happens when you pay less into Social Security when you retire? You get less, right? And I'm not going to be guilty of telling somebody you should rely on Social Security like hardcore. Like I would think it's political suicide if any candidate would say, hey, we're going to kill Social Security, right? But you will get less back in Social Security. So if you're going to do something good with the savings from your S corp, like invested in something, that S corps are an awesome idea. You know, but if you're not financially disciplined, you got no savings, and you're going to have to rely on Social Security, you're close to retiring, maybe take that into consideration. Okay? Yeah, and you can't have it back for 5 years. That's a killer. Okay, lower Social Security checks. So yeah, it's not just a, hey, I made enough, let's go. There's a couple other considerations. Okay, we all experts on S corps now?
Yeah.
Good enough? Let me take a drink here. Partnerships, boy, I could teach an 8-hour class on partnerships. There's a lot of hair on these, depending on how you use them. I like these guys for my partnerships. I don't know. Top 3 TV show. By the way, did you know that's how they got Al Capone? He was doing, all this shady stuff, and he wasn't filing tax returns. These guys are legally obligated to file tax returns for their drug money. Yeah, there's actually a line on there on the 1040 that says, hey, is any of this part of, are you essentially selling illegal drugs? You're supposed to check yes or no. My gosh. I've never seen anyone check a yes, but I would love, I'd take a screenshot. Anyway, just like an S corp, the taxes are passed through and the income is passed through to the individuals, the owners, okay, and they're taxed at that level. Okay, you can have a 99% owner partnership and a 1% owner partnership, and the 1% will only be taxed on the 1% of the income the partnership makes, right? It's best if you have multi-owner rental properties. It's a great way to do that. It's my favorite entity for multi-owner long-term rental properties. Fix and flip, I like S corps a little bit more. Active partners pay self-employment taxes. The investor partners don't, or passive partners, I guess they technically call them. Okay. If you are a real estate agent and you have a spouse that has nothing to do with real estate, don't file as a partnership. Just file as an S corp. IRS is looking for that. Okay, so S corp versus partnership. Like I said, it's best if you're making 50K in net profits, I think, and you're on an upswing. It's a solid idea to start doing S corp. You're going to save some money. Passive investor can do that. I just talked about that. S corps for real estate investing, they're awesome for fix and flip because that is an active activity. You buy a house, you fix it up, you're putting your sweat equity into it, you sell it for money. That's considered a business activity. You're going to have self-employment taxes on that. So an S corp is going to put the kibosh on a big chunk of those self-employment taxes. S corp's awesome for that. Okay. However, if you take nothing else from my class, never, ever, ever hold real estate long-term in an S corp. Don't do it. It's a capital gains minefield. You guys heard about the step-up in basis? If your kids inherit a property, then it becomes market value at your death, and they can sell it and have no capital gains tax. You guys heard that? If your property is an S corp, that will not happen. If your property is in an S corp that you fully own and you sell it to another entity that you fully own, capital gains tax. Don't do that. Okay, that's a bad idea. Good for fix and flip, bad for holding on, long-term rentals, short-term rentals. Just, trust me on that one's going to hurt. Okay? Any questions on partnerships and entities and all that? We're doing on time.
It's 12:08.
12:08. Is that lunchtime?
We will be here in like 5-ish minutes.
5 minutes? Okay, I got another 5. This is kind of the good jumping point, but deductions versus credits. So a deduction is a write-off, like our intro video. Really glad I found that because it's one of my favorite shows, and usually they swear a lot, and I can use that one for a CE class. Anyway, a deduction reduces your taxable income, okay? And it reduces it by your marginal tax percentage, generally speaking, close enough. Okay, for example, eligible business expense. Let's say you spend $1,000 on mailers. You get to, and you're in the 22% tax bracket, taxes owed reduced by $220. I'm ignoring self-employment taxes, but you guys get it, right? So I always think it's funny when people say, hey, that company's just donating to charity for the tax write-off. They're probably spending $100 to save 30 cents. Is that financially is that financially smart? I mean, they're doing it for other reasons, right? There's probably some PR in there and they want to help a good cause, right? So people don't give things away just for the tax write-off because they're going to save more money if they just never spent it, okay? Same with you guys. Every December I get, a dozen, it's usually men, who are like, hey, I want to buy a truck. I want to buy a 6,000-pound truck, and I'll talk about that later, but I want to buy a 6,000-pound truck so I'm going to get lower taxes. Like, is that really why you want it? Or do you really want me to tell your wife it's okay so you can buy this $90,000 truck for the business for the tax write-off? Like, well, yeah, it's that. Okay, well, I'm not your husband or your caretaker, but anyway. Okay, sorry, that's kind of hard to read. It says credits. They directly reduce or refund tax dollars on a 1-to-1 ratio. So if you have, that should be $2,200, by the way, child tax credits. They've moved around a little bit. So if you have a child tax credit of $2,200, you're going to reduce your taxes by $2,200 per kid. Yeah, as long as they're under 17. There's a handful of other rules. Is that a good deal financially?
No. And why
I love my kids.
17? They are.
I love my kids, but I didn't have them for the tax credits. They cost a little bit more than $2,200 a year. I wish they didn't, but they're worth it. I don't know. Okay, so here's when I talked a little bit more deeply about deductions. That's a handsome fellow. That was my Halloween costume, by the way. IRS agent. I don't know. I can't help it. It's not how you justify a deduction to the IRS. It's how the IRS lets you justify a deduction. Okay, so like, hey, I did this because of this weird, winding thing, and there's court cases about how you're not allowed to do that, let a little more blunt. Like, you're probably going to lose that if you're audited. So like, hey, I'm writing off my dog because he's my guard dog. Like, really, you have a Yorkie, and he's guarding your house, really? Like, that's probably going to shut down. So, okay. All right, let's keep going a little bit until lunch arrives. So we have deductions. I love Seinfeld. Maybe I'm just a child of the 90s. Business expenses, they're costs incurred in the ordinary course of business and specific and exclusive business use. Okay? There's some exceptions to that, like vehicles, where you can use some personal and some business, right? But for the most part, if you're buying something, you got to use it exclusively for the business in order for it to be a deduction. Now, people bend these rules all the time. Like, I bought a camera that I use like 99% for, reels and video production and stuff for my business. If I take that out on a family vacation and take a photo or two, like I'm using it for my business almost exclusively, right? Okay, but I have influencers all the time who say something like, hey, I bought this thing because I featured it in one reel and I advertised it, and then I kept it and used it for personal use. Can I write that off? Probably not. Good luck. Now, if you did that and you gave it back or it was sent to you, you can't write it off anyway because somebody bought it for you. Like, you can't write off something that somebody else paid for, generally. But you guys get the gist, and that's one of the handouts too, is the common real estate agent deductions. That's the second handout. It's got a bunch on there. That list is not exhaustive, of course. There's no possible way I could do it be, really tall. But it gives you a pretty good idea of things you could write off in your business, okay? And again, this is kind of your general rule. Costs incurred in the ordinary course of business. Exclusive use in your business. So if you're buying things that you know are going to use for real estate, go for it. Business expense. Sweet. Bookkeeping, accounting, tax prep, yep. Professional memberships. So I put an asterisk on that because country clubs are not allowed. That's actually explicitly stated in the IRS code. Hey, I have a country club membership and I win business by golfing with my buddies there. Can I write off the membership? I wish. So, but your professional membership to, I don't know, the UCAR or the NAR, all those dues you pay, of course, those are deductible. Sorry? Topgolf, we can talk about entertainment. That used to be deductible 50% until 2018. When the Trump administration, when the Tax Cuts and Jobs Act, every bill has some good and bad in it. I'll talk about education a little bit more. But memberships, courses, seminars, if you had to pay to be here, for example, then yeah, that would be a tax deduction. Okay? Cell phone bill. It's pretty hard to do business in 2026 without a cell phone. What do you think? Okay. Home office. This is one of my favorite ones that people miss all the time. If you have an old school accountant, they might tell you don't do a home office because it's risky. There's a great rule that was in, I want to say 1993 that they passed out. You can have an office somewhere like here in this building, and you can have an administrative function office at your house. If that's all you, if you use that room in your house and that's all you use it for is business activities, you can have a home office as well. Nice little deduction in there. And the beautiful thing about a home office isn't necessarily the home office deduction itself. We're going to take that all day. But it's the first mile you drive away from your house, if it's for a business purpose, is a business mile if you have a home office. So that's the real play with the home office. Okay? It's based off the square footage of your home. There's two ways to do it. Where one way you can include your utilities and your mortgage interest and property taxes and utilities, all that. Did I already say utilities? Not really. Yeah. There's also a simplified way where you just do $5 a square foot. You can leave the math to your preparer. By the way, if you're trying to qualify for a mortgage, do the simplified version. You get the tax deduction, but it doesn't count against your mortgage qualifying income. Yeah.
So what if I use my garage to store all my signs and key boxes and stuff like that?
Yeah, it can. I have a video studio in my house. I use that. That's all I use it for. Garage to store things is what she asked. If I have a garage and I use that, if that's all you use it for, that space is good. It doesn't have to have a wall. It doesn't have to be walled off. But if you just use that space, yeah, count that square footage. You're using that to store business assets. Yeah.
Write a home office expense despite you are not having any income that year.
Okay, so that's tricky. If you find yourself near the end of the year and you have all these expenses but you haven't made a single dollar, go make $1. Because if I file a tax return with zero in revenue, like that's very highly suspicious. It's probably gonna get shot down. If you do it that way, you're limited to $5,000 of startup costs that you can deduct. So go show it open. Tell somebody, hey, can you hire me for $50 to go open a door? You know, just make some revenue during that year, and you will be far less on the IRS's radar. So, good question. Yeah, in the back.
So I was told if you have an S corp, instead of writing on square footage, you just take a percentage of your utilities.
That's not fully true. You have to set up a rental agreement. An S corp is a whole thing. I could probably talk another 2 hours about those and how to really get that set up. That would be according to your accountable plan. When you set up an S corp, you need to set up one of those that dictates, hey, I'm going to rent my office at this market rate. It's got to be reasonable. So you rent it to yourself, essentially. It's not just utilities. Good question. Yeah, it's got to only be used for business. So if an auditor walks into your home office and there's your kitchen table in there, or it's a bedroom, like you don't have a home office. I've seen some where we had a client who had like a 20 square foot office. Didn't have a wall. It was just a space in her, I think it was her family room. Like it didn't have a wall, but she had her desk there and her computer and her printer. That was it. That counted. Again, she wasn't after the home office deduction. She was after the mileage. So the home office doesn't have to have an official wall. It just has to be a space dedicated for your business. Okay? Question?
So if my home office has multiple computers and not all of them are being used for work purposes, do I write off only the square footage of work? That's only my work computer?
Unofficially, I would take that non-work computer out of the room before the auditor arrives. Just saying. Question?
When you write off a home office in your private residence, then you go to sell it, what's the best strategy?
Yeah, so that can sneak up on people. If you have a home office and you sell it and you have depreciated your home office, you can do that. When you sell it, you are going to have an ordinary gain. If you sell the house for more than you bought it for, which is really common. So you're going to have whatever you depreciated at over the years, and it might not be much. So but it still kind of stings when you see it. Like, oh crap! You have to recapture that depreciation. If you use the simplified home office method, you don't have to do that. So there's two reasons to do the simplified one. It's simpler for us. That's selfish, I guess. But it helps you qualify for a mortgage better, and you don't have that depreciation recapture. So if you depreciated your home office for $20,000 over the years, and then you sell your house for a profit more than $20,000, that first $20,000 is going to come back at ordinary income. Ouch. So, great question. Okay, ready to move on to vehicles? Are we ready for lunch? Are we ready yet? We need another couple minutes. Really, you good? Should we eat or should we give it a second? All right. Okay. I know we're hungry. While they're setting up boxes, it's my time to advertise according to Spencer here. So you guys know what I do by now. I am a CPA. I specialize in real estate and real estate agents. Somebody help me with handouts, please. Should have done this before. Here's one. Here's another. Thank you so much.
Are these different? Are they the same?
Yeah, they're different. Yeah. So you might want to tail her. Thank you. So yes, I'm a CPA. That's what I spend almost all my time doing. I happen to have a mortgage license too. And any of you have a lender who's also a CPA? Pretty rare. Let me tell you the advantages of that. When you have someone who has control of the tax return, is licensed to give tax advice, and can file that tax return, who knows exactly what your underwriter is looking for on the tax return, that's pretty dang powerful. My tagline on my business card and on one of my flyers is, I can help you look rich or poor to the IRS and rich to a bank. That's pretty fun. Yes, we can still do bank statement loans and DSCRs, things that don't require tax returns. You guys know the pros and cons of those? They're awesome, by the way, and they can absolutely fit in the right circumstance. A bank statement loan uses what instead of tax returns? Bank statements. What kind of rates do you get on bank statement loans? Are they higher or lower than conventional loans? Higher. I often run those, and there's usually somewhere between a 0.75% and a 1.5% difference in interest rate between a bank statement loan and a conventional loan. That's pretty significant in our clients' lives, right? There's some pros and cons of that too. Like most bank statement loans don't require mortgage insurance, but they also do require at least 10% down, sometimes 20%. And so if you can help get your clients get a better mortgage and have a more affordable payment by using the tax return legally, by the way, I'm never going to break any laws. That's never on the table. But there are certain tweaks I can do in the tax return to do that legally, to help you look poor to the IRS and rich to a bank. If you don't have a lender that can do that, give me a call. Okay, Jared's on my team, stand up. He's on my mortgage team as well. He's the one that takes through underwriting. I just happen to know the front end financial and income side really, really well. So, okay, any questions about that? You guys hungry? We brought Costco pizza. No. We'll give you a few minutes to get that situated and bring it back to your desk, and we can keep going. Okay. Yeah, that's a whole thing.
I know. But I live with Daniel. I wrote his dad.
He's a great guy.
Yeah, his dad loves to talk. But Daniel, I like. We've gone a couple of years back, and I haven't heard this. I can't find it in any of my emails. I think it's Daniel.
Probably.
But I'd be curious to talk. Daniel knows all this stuff, or does he know it all?
Yeah, we talk to each other a lot about certain clients. Like if I have something involving crypto, he's great for that. But if he has anything involving real estate, yeah, he's out so long. Yeah, we talk all the time. Hi, great. Toasty, actually. I'm gonna do this. Oh yeah, I need to probably go inside. It's in Midtown. So yeah, Cottonwood Heights-ish. Great. So normally how that works, depending on what you mean by messy, we send you a portal, you upload your documents, we can do some back and forth questions there. Then we prepare your tax return, and when we're done with the draft, but before we file, that's when we schedule a meeting, and we do, okay, here's where we need a little more, here's some extra strategy based on what we see here. Is this return correct, all that, and then you sign and pay and off you go. Does that make sense? You can schedule additional strategy meetings. We charge hourly for that. But you get, a piece of that after you file your return. Yeah. The number, that one at the top is our office number. We can get also. What's your name? Orlando? Nice to meet you. Hi. Okay. Okay.
So, choose the baby.
Okay. I don't blame them. Yeah, we got I'm not gonna say you could. If it is, are you filing it on a partnership return? If so, then we could. And also, you can just buy my time if you want, and I can just tell you, here's what I want to tell you. You don't have to buy all things, but what's your name? Your mom loves you too. Well, that's what my mom calls me, but she's not here. So I'm with you, right?
Thanks.
Okay. Thank you so much. Came in like amazing lifesaver. Nope. I'm not gonna eat anything because it messes up my. Are you ready? Appreciate you though. Okay, thank you so much. Hi. Great. Congratulations. What do you mean retired? Okay. And you're good switching over this? Yeah, once you start making about 50,000 in net profits, that's when it's a great time to talk about S-corps. Yeah, before that, you're going to end up paying me more than you're going to save, which I don't recommend. Yeah, I think so.
I was curious about that. That's basically why I get asked that question.
Well, there we go. Hope I answered it.
You did. Thank you.
Sorry. All right. My firm can, but I personally don't do a lot. Usually it's business. Oh, you want to sell the real estate? Yes. Usually farms are recorded on a Schedule F on your personal return. They can.
If you want the CE credit, now's a good time to look up your license number so you can have that ready.
Thank you. Yes. Include the suffix, the SA00 or PB, because I don't want to look you up. Probably just be an investment, I would say. That's probably just like Schedule B, gain or loss. We'll do that when you buy and sell.
So how do we get more numbers?
Yeah, you're welcome.
Oh, at the very end, he's gonna have a QR code, and then you'll fill it out. So that's where you'll put your number. Yeah, it's a great stuff.
know what? I don't know. I don't know who this other person is. I don't know. Yes. He's like,
Hi.
I don't know.
Sorry. All right. All right. Yeah. It'll be faster actually if you come my office. There are people answering the phone a lot more often than I am. That's set up. We'll explain how that works. Usually the clients have it after we get back and forth. Better do so.
It's funny that I was gonna say Caleb and then I went with that.
Yeah. Why?
He actually did like go.
I'll talk about those. He doesn't need to be an owner in the S corp. He can be on your board. You can do that if you want to, and if you have your trust set up right, he's going to inherit it anyway. So he's not actively working in your business. I don't want him as an owner. Not directly. That's kind of a loaded question. There's a lot in there, maybe. It could. It just depends on. Before you file your return, maybe.
Well, we started.
I don't know. Yeah, you could do that. It's not going to be a big deal either way. I don't think. So if you don't feel like it's worth it, yeah. All right, we're going to get started because there's a lot more to cover. Some of the good meaty stuff. So gather round. Give me another like 20 seconds, 20, 30 seconds. All right. Let's have a seat, please. Let's keep it going. By the way, everybody who has a bag of chips, will you open it right now? Let's get it out of the way. This is my first rodeo, right? Thank you. All right. Now let's talk about vehicles and mileage and all that fun stuff. Okay, before we talk about those, well, let's get into it. So there's a couple ways you can write off your vehicle expenses. There's the actual expense method, where you can write off, the cost of the car itself over time via depreciation with some special rules there, your gas, your repairs and maintenance, your oil changes, your blinker fluid, all that kind of stuff. That's the expense method. The other method you can do, and you can't do both, it's one or the other, is the mileage method. Now, the mileage method in 2026, extra bonus points if somebody knows how much per mile you get as a tax write-off. 70 was 2025. 72 and a half. There we go. 2026, 72 and a half cents. That's pretty powerful. So if you have 20,000 business miles, we're around $15,000 of a tax deduction for the mileage. Pretty nice. Now, if you do the mileage, that assumes that you're paying for gas and for repairs and oil changes and blinker fluid. I don't know, I think I'm funny. So you can't do both. It's one or the other. And when you purchase a car and put it in the business is when you decide, because you generally can't switch back and forth. Okay, they pretty much lock you out. So you decide when you buy the car. That's a great idea to call your tax professional as to when to do that. Generally, just shooting from the hip here, if you have a car that gets great gas mileage and you bought it for less than $35,000 or $40,000, your mileage is probably going to end up being better in the long run. Okay, even if it's 6,000 pounds. Yeah. Electric car. There used to be a nice tax credit for that. That went away as of September 30th. 2025.
But can we do mileage or no?
Yes, I have an electric car. I'm doing mileage all
Just
day.
mileage. Okay.
Yeah, the maintenance on that sucker is low.
Yeah. Okay.
If I bought my car with personal funds, is there a way I can now switch that as a business asset expense?
The question is, if I bought my car with personal funds, is there a way to switch that to a personal asset or to a business asset? Yes. You just do it on the tax return. If you're trying to qualify for a mortgage, you notice there's a theme here. Mileage is going to be better, almost always. Because guess what? Mileage doesn't count against you when they're calculating your DTI, even if you spend money buying it. So the best way to do that is buy it with the LLC if you can. Now, it's hard to get credit in the LLC at first, especially if it's a new LLC and you don't know how to build business credit. But if you possibly can, or if you have cash, buy it in the LLC's name and use the mileage method. That will not show up on your credit report, and that will look gorgeous on your tax return on your mortgage qualifying income. I've boosted somebody's DTI or mortgage qualifying income by over $1,000 by doing that. That can matter. Is that another question? Yeah.
If you already had a vehicle from years ago that's personal, and now you're a real estate agent, and can you still deduct?
Yep. As long as you're using that vehicle for business purposes. Now, you don't want to sell it to your own business. That has a lot of hair on it, and it's not going to do you any good anyway. You can just start using the mileage on it.
Even if it's not in an LLC?
Even if it's not an LLC, yeah, you're using that. Now, if you're in an S Corp, you want to have that as part of your accountable plan. Hey, I'm renting my car to my business for X amount of dollars. That's usually just use the standard mileage rate for that. 72.5 cents for 2026. Okay. Good question. So if you have a car that you've been using and you start being a real estate agent today, just use mileage. That's probably the cleanest way to do it. Okay. Good question. Okay. How are you tracking your miles? I already cheated right here a little bit. There's a few apps out there. I don't represent Mile IQ. I haven't used it myself. But Stride is out there. Everlance is out there. There's a whole bunch more. If you just search on the App Store or Google Play Store, you're going to find 100 of them. Okay, but your phone goes with you pretty much everywhere you go, right? And so if you have something that's going with you and it's tracking your distance, at some point, I usually do this on Sundays when I'm doing my own bookkeeping. It's going to prompt me to say, okay, here's a list of the trips you took. Swipe left if this one is personal. Swipe right if this is business. It's Tinder for business, right? So I've never used it. I got married way before that happened. Anyway, but yeah, it'll just tell you, hey, you drove from this address to this address. Is that business or personal? Swipe left or right. It'll tell you. Now, normally you want to put a business reason in there if you can, or if it's one you keep recurring, that's pretty obvious. But they make that really easy. I still have people using pen and paper sometimes. Good for them, I guess. I don't know. You can do that as long as you're tracking it accurately. Okay? If you're using expenses, you have to use a percentage of your business use. And by the way, if you only have one car, I dare you to do 100%. The IRS probably will raise an eyebrow at that. I know many of you probably have done that and gotten away with it. I'm just saying what's legal. Like, do you never have any sort of social life whatsoever? Like, that's what they'll ask, right? They'll probably deny you if you try to claim that. Okay? So you're still supposed to track your miles anyway, even if you do the expense percentage. Okay? Now, if you have multiple vehicles and you only use that car for business, you have a case, right? You could do that 100%, sure, right? In that case, you could just you just use that. So then you just take your receipts. You have gas, repairs, maintenance, car washes, detailing, all that kind of stuff. Depreciation, it's usually the cost of the vehicle over time, right? It's usually over 5 years, and it's not exactly 1/5 of the vehicle, and it's a little more complicated than that. But that's how you write off the cost of the car itself. You depreciate it. It's like a piece of real estate, except for a shorter timeline.
Can you choose whether to depreciate it, take it all in 1 year versus over 5 years?
If it is 6,000 pounds, good question. I think one of those wheels is 6,000 pounds. You know?
Yeah.
Anybody heard of the 6,000 pound rule besides Spencer? All right. So the 6,000 pound rule, if you buy a vehicle that is over 6,000 pounds, you can deduct up to the business percentage, like in one single year, even if you get it on a loan. So if you put $10,000 down on a $200,000 G-Wagon, you still get to deduct $200,000 in that year. Okay, that's leverage. That's kind of neat. But there's some pitfalls to that. If you sell that G-Wagon next year and you have a capital gain, like that depreciation recapture is going to hit hard. That is taxed as ordinary income. Okay, so if you're going to pull off this rule, Do so knowing that if you sell it within 5 years, you're going to have some depreciation recapture, and it's going to hurt. Okay, so there's awesome cases for this. By the way, this rule predates the SUV, so it was designed for utility trucks, and then America got America, and they built big diesels and 4x4s and all that, right? But you can take that. How do you know if your car is 6,000 pounds or not? Oh yes, the sticker on the door. When you open the door, that tells you how much air to put in your tires. There should be a little thing in there that says GVWR. Stands for gross vehicle weight, ratio? I don't know. And then there's a weight right after that. If that is 6,000 or more, you can do this. Don't believe your dealer, don't believe Google. Google was wrong about my truck when I had it. Okay, it's on the sticker itself. So if you're gonna pull this off, make sure you have proof of that on the sticker of the car, okay? So everybody understand that? It can be a powerful deduction, but be careful because if you sell it, it's going to hurt. Also, it does look a little worse on a mortgage application. Yeah?
Can you also take mileage deduction sequentially after the following years, or is that it?
Yeah, that's the only time where you can switch, and it's a one-time switch. After you fully depreciate the vehicle, you can switch to mileage if you want to. But generally, when you buy the car, you're kind of locked into your method for at least 5 years. Okay? And if you're mileage, you can't go back. You can't go back to the deduction. So. Okay, good questions. What determines if a mile is a business mile? Sorry? The purpose. Exactly. So hey, I'm driving around town with my logo on my car. Every mile is a business mile, right? Unfortunately, no. I've read no fewer than 6 court cases shooting that exact argument down. So if you're audited and that's your defense, pick another defense. Question over here? Yeah, how long does it take to depreciate a vehicle? It's 5 years. And it's not an even 1/5. It depends on how you depreciate it. You can do it straight line, or you can have a higher. It's kind of complicated. You'll have capital gain if you sell it for more than its book value. Yeah. If you do mileage, there's no capital gain tax. Another question? Travel. Okay, whenever I think about travel, for some reason, I think about this guy. I don't know. Used to be able to give him more crap when he was on the Rockets, right? But I don't know. Okay, so travel expenses is going to be like airlines and lodging and your food for that day, your Uber, your car rental, things associated directly with travel. Okay, when you're going to conferences, trainings, and even client meetings, you can deduct travel expenses for those. Okay? Here's one of the big kickers there. It's got to be 4 hours a day doing actual legitimate business activities. So, if you are on a trip and you go to Maui with your family and you are, quote, looking at houses, is that business activity? Yes. If you go with a client and they're there and you go under contract, then yes. I saw an auditor, or rather I heard a rather loud one in the office next door when I was first starting out about this very rule. Like, it was a real estate agent who was getting audited, and they said, yeah, I was looking at houses. Like, well, did they go under contract? Did they buy the place? Well, no. Then you don't have a deduction. Boom, sorry. Game over, period, current. So be careful with that. Now, if you go and it's multiple times and it takes a couple times and you meet the client there, yeah, fair game. Go for it. Okay? But if you're going there to look at houses, I've seen that shot down so many times. Be careful with that. Again, I should have made this point earlier, but I'm not a cop, right? So if you're doing something I know isn't right, nobody's going to tell on you. The only time I would do that is if you're defrauding the IRS by at least $3 million, I get a bounty for that. I've never run into that, and I don't want clients like that, so it's never going to happen. But if you do something on the tax return I know it's not right, like I'm gonna try to go for plausible deniability, honestly. Like I say, you put $20,000 in travel expenses, I might ask a question because that's a little bit high, but I'm gonna believe whatever your answer is. And if you're audited, that's what they told me. I documented it. Good, it's on you. Okay, so how much risk you want to take is up to you. And I will ask questions if I feel like something is risky. But at the end of the day, if you want to write something off, unless I know it is blatantly, terribly against the law, I'm probably not going to notice or try to stop you, right? So just if it feels like, hey Dan, you're being really conservative on here. The stuff I'm going to show you on investment stuff is going to save you far more than you trying to write off your travel expenses. So if I'm going to take those big giant swings, I'm not going to sweat the small stuff because the IRS, if they audit you, they're going to look at that small stuff and they'll bust you for it. So I'm going to take those big swings. That's where we're going to save our money. Okay. All right. So airline tickets, meals, lodging, rental car, Uber, that kind of stuff. Those are travel expenses. Sure. When you do 4 hours a day. Entertainment, again, I hate that this got shot down, but it does. If you ever notice when you go to some of those conferences out of state that they take you to fewer sporting events and such like that, it's because they can't write it off anymore. They're not supposed to. They might take you anyway just because goodwill. They might even try to write it off. But as the 2018 Tax Cuts and Jobs Act of 2017 shot that down. Now, so if you go golfing with a client, you're not supposed to write that off. Now, the way around this, if you want to call it that, is to have a client appreciation event. Who here has done one of those? Are those amazing for business? They're awesome. So you do a client appreciation event. You don't exclude in your materials anybody from attending and enjoying themselves. Why would you anyway? That'd be terrible for business. The only exception to that is don't serve alcohol to minors. But, but if you have your advertising out there for a client appreciation event and people come, yeah, write that stuff off. You can write off 100% of that cost. Now, who you advertise is up to you. But if you don't exclude anybody on that, rent out a movie theater. Buy snacks for the whole thing. That is 100% deductible as a marketing expense. But taking a buddy golfing and calling it a business expense, that would be shot down on an audit. The same.
What about is Susie still in there? Don't you do micro client appreciation events, small ones? Are those fine because you advertise to everybody and just say it's limited space?
See, the word limited might get shot down by an auditor. You know what I mean? I get it. I would try to do it anyway, but just tailor your
Let's call it an event.
I would never call it micro anyway.
This is at a brewery, maybe? Microbrewery? Sorry. No, but I would just leave that off the flyer. You know, invite who you want. Okay. All right, vacation days before and after. Okay, so here's where I talk about one of my favorite tax deductions. If you all have an LLC, have you all named board members to your LLC? I've named my wife and my 2 kids to my board. They are not owners of my LLC. That's me. We have a board meeting every time, well, not every time, once a year when we go on vacation somewhere cool. Sorry, it's not a vacation, it's a trip. Use the words carefully. It's a trip. So, what we do is we actually hold a board meeting, and they look forward to it. They do, no, because I'm teaching them about business, I'm teaching them about responsibility. We actually do a legit board meeting. We have an agenda, we take minutes. They get an invitation, like we rent out a space in the hotel room, or we do it in our Airbnb, depending on where we are. And we have a 4-hour board meeting. I know that sounds like a lot, but trust me, it goes by pretty quick if you do the right things. We go over our finances last year and this year where we are. Let's set some goals. Let's go over our accountable plans, get that stuff out of the way. Let's take minutes. Let's do some trainings. Let's watch some videos of our favorite professionals who do things better than we do and learn from them for a couple hours. Whatever. And then let's top it off with the lunch. Awesome. You have 3 days of deductible travel days. You have the travel day there, the travel day back, and the day you hold your board meeting. So if you go for a 3-day trip, and that's what you do, that's a boring trip, by the way, you can take 100% of those travel expenses. If you have a week and you do this, you can take 3/7 of your airline ticket, your hotel, and you can take the meals for that day. Okay, so have a board meeting. Name the board members in your LLC documents, and you can do that. That's totally legit. I've seen that pass audits all day. Don't just go somewhere and just, try to write all of it off. Be careful with that. Okay? So that's the way to do a great travel deduction. Have a board meeting. You're supposed to do it anyway if you have an LLC. Yeah.
Do your kids have to be a certain age to be on your board?
So my 11-year-old son and my 14-year-old daughter are on there, but they actually contribute to the business. My daughter and son are both learning how to do some video editing. They're getting kind of good. And they contribute. They give me some ideas. I employ them in my business. I hire them. That's another slide we'll talk about, hiring your kids. So I probably wouldn't put a 3-year-old on your board. Because how are they going to contribute?
But if I said my 6-year-old door knocking for me, where she's handing out all the
Cute.
flyers and have her help with events and stuff, does that?
She's probably more of an employee than a board member, but yeah. Anyway. All right. Any questions about travel? Yeah.
What if you're traveling to invest in the property you own, you are using it as a vacation, but you're also upkeeping the house, making sure, how much value you're writing off.
Record the days you're working on it. 4 hours a day is a typical rule. Yeah, but yeah, if you're working on your investment property, it's a great reason to take a trip. Right, bunch of that off. All day. Not the whole thing though, just the time you do it. It doesn't count as a rental day either for the guest rule stuff. Yeah.
So this actually happened. I went on vacation with my family, and during it, I definitely had to work 4 days because my client decided to go under contract when I was on vacation. It fell through later, but I did went under contract.
So you're just on the phone a lot and on emails? Made your family mad?
Yes.
Yeah. So that's another one too. If you're on your phone, like you could have been on your phone in Utah. And so I've seen an IRS agent shoot that down too. Again, what you claim is up to you. Like I'm just telling you the rules. Don't shoot the messenger.
I mean, it makes some things more expensive, so I would just probably write those things off.
Again, it's not how you justify the IRS. It's how they let you. I've seen that one shot down before. Like, hey, I know I was on the phone for 3 of the days. My family's furious. Can I write that off? And I've seen that shot down.
What if
Sorry.
it converts to a sale? Like, if it goes under contract?
If it goes under contract, great. Yeah. Then, yeah, take it all day. But not if you're on the phone in another place and you're not, like, in the area where the transaction's happening. Does that make sense? So if you're on the phone in Hawaii and you're under contract here in, Provo or Orem, like, that doesn't count as a business trip because you're not there to do business for IRS standards.
Those hours don't count.
The hours don't count. No. Sorry. Again, just the messenger, right? Yeah.
So if you are on the trip and you don't like the board meeting, are there certain minutes or criteria you have to have, like discuss what like the vision for the year, goals, or
Take minutes, and if the activities are business related, you're good. Generally 1 per year. We'll talk about the Augusta rule where you can have mini ones that don't do the 4-hour day rule thing. Where you rent out your house to your business. You can do that. That's a fun one. Any other good? Those are good questions. What time are we at, by the way? It's shoot.
Oh, wow.
Time flies when we're having fun. Okay, I got to do this one. Meals 50%. Why is it 50%? That's the rule for the IRS. Does that mean if I have a meal with the client and it's business related, that I send 50% of that expense to my account? No, because I'm going to chop it in half again. So give us the full amount and then put it on the tax code, right, on the tax return. If you're not traveling, eat with somebody, and it can't be considered lavish or extravagant. So if your dessert has gold bullion in it, it's probably extravagant. The only time I've seen this really enforced is there was a client of a coworker back in the day who they took they spent like $4,000 on a meal, and $3,700 of that was alcohol that they bottled up and took home. They tried to write it off. You got slapped out. Meals to network, prospects, clients, referral partners, all deductible. Go for it. The rule is eat with somebody and talk about business. That's really it. If you're traveling, meaning you're sleeping somewhere else, outside, there's no hard and fast rule though. But if you're traveling, legit business travel, you don't have to eat with somebody to have a 50% meal deduction. But if you are in your area, you have to eat with somebody. You got to talk about business. That's the rule. You get to write it off. Yeah.
So I know this is very specific and might not help a lot of people, but this is my actual case scenario. I had to learn how to ski.
Is this maybe an after? We're really low on time. Is that an after thing? Or?
I'll be very short.
Okay, sorry.
I had to learn how to ski so that I could access Deer Valley ski in and out properties. A lot of cost goes into that. Passes, gear, all of that. Is any of that rideable?
That would probably be considered an entertainment expense. If I knew about that, I'd probably say no. I would suggest you could say no on that one. I wish. People try to take people skiing all the time. I wish, I promise. I hate that one. Write a quick note on your receipts with whom and why. Then take a picture of it, right? Deductions like retirement. These things like 401ks and SEPs and IRAs and stuff like that, those usually defer taxes. If you take a write-off in the year you do that one, like you contribute to your solo 401k, when it comes out, that's when it's taxed. If you have a Roth, it's different. That goes in after you pay taxes, right? That's after tax money. Great way to have a little more control over your tax bill. I like solo 401ks better than SEPs, honestly. I won't get into why. Health savings account, this is probably my favorite vehicle in all of the tax code. So it avoids taxes entirely. You put money in pre-tax, it grows tax-free, and you take money out tax-free, as long as you spend it on things like Darla's braces. It's got to be like specific medical stuff. It can be co-pays, it can be prescriptions. The strategy here, I don't have an HSA because my wife works for a hospital and they have amazing healthcare. But if I had one, I would never spend a dime in it until I retire because that sucker's growing tax-free. I know a guy who owned 5 head of cattle inside of his HSA. I know another one who owned an apartment complex inside of his HSA. You can do some pretty wild stuff with those. So next time that health insurance texts you, hey, we want the NAR. You know, those spam texts, no?
Sign up for HSA.
Sign up for, yeah. Ask them if it has an HSA. They're actually the best person to ask if it's eligible for an HSA. It's got to be a high deductible plan. Don't ask me. Your health insurance agent should know that. Yeah. You can roll over all. It's not use it or lose it. Yeah, HSA. FSA is flexible spending. I won't get into those. I don't like them. But an HSA, you can contribute in 26, $4,400 if you're a family, $8,750. So it's going to take a while to grow. But with the right vehicle, you can invest that in anything you want to. Fidelity won't let you because or like Schwab and those guys, they want you to invest with them. But there's ways to self-direct this stuff and grow however you want. Kind of cool. Love HSAs. Hiring your kids. It's a great way to do that. Teach them responsibility. If they're under 18, you don't have to W-2 them even. If you pay them up to $16,100 in 2026, you don't need to W-2 them. Kind of nice. And you can help pay for their extracurricular hobbies. My daughter's guitar lessons, my son's baseball. Yeah, he works for my business. He does legitimate business activities, right? And he has a reasonable wage. It's not $300 an hour, by the way. Okay? It does teach responsibility, of course. You can do that. And you can also set up a Roth IRA because they have earned income. Even though you don't have a W-2, you don't have to do that for your own kids, your own blood children or adopted children. If you hire the neighbor's kid, you got a W-2. So, legitimate, age-appropriate tasks. Okay, my 11-year-old son, I haven't taught him how to do my bookkeeping, so it's got to be, and you guys can be creative at what they're good at. They can help you clean stuff. They can help you stuff little bags for open houses. They can maybe help you make flyers if they're old enough. Be creative. You can hire them for that kind of stuff, pay them decent, and have them put that towards their hobbies. Yeah? No, you can do it regular. There's actually an extra step if you have an S corp. Quick transition. You do like a little family support company, and that's just on the tax return. You don't have to set up an LLC or anything. That's the way it has to go for an S corp. Otherwise, you have to W-2 them. If you just have an LLC, you just put it as outside services expense. Okay, just pay them that way. Easy peasy. They're both easy. Okay. I know I gotta go fast, but there's a lot more to cover here. So, okay. Caleb Williams. He got in I don't want to call it a legal fight, but he kind of was fighting the NFL when he was hired. He wanted to be 1099 because he wanted to write off a bunch of business expenses. I won't go too hard. Well, I should talk about W-2 versus 1099 because it matters. When can you W-2 versus 1099 somebody? Anybody know the difference? What's preferable as a business owner? 1099. Why? You don't got to pay their taxes. You have to do workers' comp. Yep. Mm-hmm. But there's rules to when you can and when you can't. Caleb Williams works for the Bears. They tell him when to be at a certain place, what time, and what he has to do. Those are the rules. He can't be 1099. They got that shot down. So that's the rule. If you're hiring somebody and you tell them they have to be somewhere at a certain time, you give them a schedule. They can't do what they're doing for anybody else. You have to W-2 them. That's an IRS rule. Now, if they're doing like your photographer, you got to 1099 them because they can do what they're doing for all kinds of real estate agents. You don't tell them exactly what hours they have to work consistently. Okay, so there's rules on when you can and can't. You can't choose. If you're up in the air, talk to your accountant about when you can do what. Because how you hire them will matter on that. Okay. You can add your kids to the board of advisors. If they're above 18, you have to give them a W-2 or a 1099 based on what they're doing for you. Okay. Also, if you have health insurance and you have a 24-year-old on your family health insurance, hire them instead and tell them to get their own dang insurance because it's going to be a heck of a lot cheaper than you paying for it on your own policy. You can even pay for his or her policy. It's going to be way cheaper to have their own. Trust me on that one. No, that's a good move because they're not making very much income. The ACA comes into play and they're going to get really, if not free, health insurance. and it's going to cost you probably a few $100 to have them sticking on around on your insurance. So, yeah, there's a little health insurance tip. Okay, strategic SALT payments. That one's a little bit up in the air in Utah, so I'm kind of going to brush over that just really lightly. If you are submitting state taxes every paycheck or every time you pay your quarterlies, I'm going to tell you to quit doing that and do it once at the end of the year instead. There's no penalty in Utah for paying for late payment penalties if you pay it by April 15th. I'm going to say December 23rd on this one because if you submit it a special way, you can guarantee to deduct your state taxes on your federal return. If you don't understand that, it's okay. Itemizing your deductions, one of those might be your state taxes. You have a chance of that being deductible. This guarantees that you can take your state tax payments and deduct them off of your federal taxes. It's just a lump sum at the end of the year toward the state of Utah based on how much you owe the state of Utah. That's a better way to do it. There's a couple $1,000 right there. Yeah. Yes. Also known as a PTE2, which stands for Pass-Through Entity Tax. SALT stands for State and Local Tax. There's enough acronyms to make someone in the military blush in the IRS. Good, yeah. So that's a great thing. I'm not going to go too much more deep into it. I want to get into the fun stuff. Well, want to play this game real quick? Can I deduct it?
Yeah.
Oh, I didn't talk about this one.
Yes.
Yeah, I was wondering about that.
Yes, Kim.
Clothing with your logo. I would say yes, but part of an outfit and the parts that don't have your logo on it, no. There's a pretty famous tax court case where somebody had their Rolex watch and they put their logo on it, $90,000 watch. Tried to write it off, got shot down. So be careful with pushing that kind of thing. But yeah, I can't deduct anything in my outfit, unfortunately. I'm not wearing a logo or anything like that. But yeah, if you have a big logo on your stuff, go for it.
What if you need business policy?
I know, I was told one time I could.
Ordinary and necessary exclusive business use. That's the rule. And technically they call it a uniform expense on a tax return.
That's great.
So, I mean, like I said, I've seen this in court too. If you have pants that don't have your logo on it, don't try to write off your pants or your shoes, right?
Yeah.
But sure, with your logo all day. Yeah.
So if I only wear business suits for work for no other purpose, can I write them off?
That would be shot down as well. There's a famous another tax court case. Anybody know who Rod Stewart is? Some of the older gents. Yeah, he was his drummer dressed exceedingly strangely, to put it lightly. He tried to write off his stage clothes, and he got shot down by a tax court case. And the judge said, "Never in a million years would I wear that in public, but you would, and because you could wear that in public, you can't do that. Sorry, no deduction for you." I've seen a TV anchor in a tax court case get that shot down. If he doesn't have a case for that, I don't know that anybody does. Just saying. Client appreciation events.
Yes.
Talked about that all day. Go for it. Makeovers. Gotta look at your clients. Unfortunately, same thing. TV anchor. He got busted for makeovers. He.
So that clip you showed is not truthful.
Which one?
The beginning.
No, it was exactly truthful because he said you can't do that.
Oh,
Remember?
the dad.
Johnny, yeah, I told you can't. That's on a write-off. Yeah,
I
that
was
was
like,
right.
sweet.
Groceries for your family.
Yeah?
No.
That was a hopeful. That was a hopeful yes.
Oh, yes.
What if
This is
they're
the
on
only.
a board?
This is one of my favorite times I fired somebody, and I rarely fire somebody. This is a real estate agent who kept pushing and pushing and pushing. It's like, hey, I talked to the cashier about real estate, so I wrote up my groceries. I'm like, well, does that mean I can go to the hot tub store? You know? Yeah.
Everything's
Question for us, like a salt tax, is there a way to pay off any of your federal taxes you pay?
Prepay your federal taxes. It's a good idea because you're going to avoid penalties if you prepay your taxes throughout the year, quarterlies. But you don't really deduct federal taxes because that would be like an infinite limit, if you know calculus. And you deduct taxes on taxes on taxes on that, and so forth. So you can't deduct the taxes you pay to the federal, but it counts as their credits, right? Because you're paying dollar for dollar what you owe. Okay, restaurant food.
If you go with somebody.
If you go with somebody and
And talk about
talk about business. Can you guys go 5 minutes without talking about business?
No.
Good.
No.
Charitable contributions.
Yes.
Yes. I would prefer if you can, if you're going to donate to a charity, ask them if they'll put your logo somewhere because I'd rather deduct that as an advertisement than a charity. Because there's a bar to clear and you can't deduct anything below that bar. But on advertising, you do it all day. So if you're going to donate to a charity, See if they'll put your logo somewhere, like your kid's baseball team or whatever. Yeah, but you still, yes, with an asterisk. Personal miles driven in a car with your logo on it.
No.
Cell phone bill.
Yes.
Utilities.
Part of.
If you have a home office or a regular office. Concert tickets for prospective clients, just a minute. Prospective clients or employees.
No.
Yeah, I wish. So there's a gift limit. I know it's different from the real estate one. Every county and every MLS has their own limits, but the IRS limit is, guess what? How much you can deduct maximum for a gift for a client? $25.
What?
That's my least favorite rule in the entire tax code. $25, and it's been $25 since 1962.
Are you guys not writing off your gifts?
I have. Wait.
So, unofficially, here's what I've seen clients do, and I don't officially recommend this, right?
Not officially.
Not officially. Officially, the limit is $25. If it costs you a little extra money to put your logo on it, you can add that. That you're good. I've seen people put it in advertising expense, and here's another fun rule: if you give someone a gift over $600, you're supposed to issue them a 1099.
Oh.
Tacky. You sell me $1 million house. Oh, if you're following the $25 rule, sell me $1 million house and give me a $25 gift card.
Yeah, might as well
Just-
not get a gift.
Yeah, just don't. Oh, gross. So some people, they will put it in advertising, and if they're caught, there's like a $200 fine for not issuing a 1099. That's what I've seen some clients try to do. My official stance is $25 is for what they do. Capiche?
The caveat with the brand and marketing. So if you laser engrave your
Yeah, you can write off that as advertising. Yep.
You have to put your logo on it.
If you want the extra cost, but that's spending money to save money that you're,
So you would recommend doing it as like a marketing or an advertising expense?
I'm officially recommending you do the $25 rule.
Well, I don't think anybody's doing $25.
So here's a business tip. Spencer gives gifts correctly. He
Okay,
doesn't
tell us.
put his logo on it. He put mine. You know, I'm going to remember who gave that to me forever. Awesome.
So then
My
how
gosh.
does he write it off?
Sorry?
How does he write it off?
He's supposed to do the $25 limit.
I made it, so
Or he did it. If you spent the money, you can prove you got the receipt. Giving a gift with your own logo on it, yeah, it's still nice. It's still a gift. It's still pretty cool. But giving it personalized for them, better business move, if you ask me. Personal opinion,
But it's still just the $25 always.
officially. Okay, credits. Not a lot of credits for specific to real estate agents. There are things like child credits, education credits. There's some R&D stuff if we're getting different kinds of businesses. Most of them end up being personal. Then we have, so that's credits. I really don't spend a lot of time on those. Quarterly payments. You guys making quarterly payments to the IRS? If you have an S corp, you should be remitting those. You're getting penalties if you're not. They're not huge penalties. Like I had a real estate agent who they made $80,000 net income that year. Their penalty for not paying their quarterly taxes was like $500. So it wasn't like huge, life changing, especially because I know your income is so roller coastery. So just plan on that penalty happening if you're not paying those quarterly. If you can pay them quarterly, awesome. You're going to save money that otherwise would go to the government. We don't like that, right? But I get it if you can't. It's not a huge, devastating blow to your bank account. That's when they're due based on prior year income. I'm going to kind of skip over the most secure way to pay those, irs.gov/payments. That is very secure. Okay? If you have an S corp, you can submit those through payroll as well with your payroll provider.
So nobody telling me that I owe money to the IRS. I should not pay.
Oh, after class, I'll tell you about how my wife got one of those called, freaked her out.
Oh.
I know. So what to keep track of: expense receipts, business bank account. You want to do that. Mileage, auto expenses if you're going that way. Home office square footage, hence there. Cell phone bill, internet, meals, quarterly payments. Yeah, if you're making those quarterly payments and you don't tell us, that's going to take a while for the state and the Fed to catch up. It might be 6 to 8 months before you get that refund out of there. So tell us. Now I know we're at the end. I was just about to get into investment and owning stuff. We had a lot of questions that kind of extended it. So do we want to get credit now, and whoever needs to leave can leave, and then we can continue if those of you want to stay?
With that?
Are you guys okay with that? Okay. All right. Let me just skip to that slide then. Sorry about that.
No, thanks. You started late. So we had enough.
Oh yeah, I did. Okay.
This is helpful, so I don't think we're bad. I know.
Okay. Oh goodness. Whoops.
On the MLS, it doesn't freaking have the -SA.
Do you know what you are? If you're an associate broker, it's AB00. If you're a principal broker, PB00. If you're neither one of those, it's probably SA00. I know. Oh, it was supposed to. My goodness. Oh, there we go. Is that good enough? It's on the left. Yeah, the best stuff is on the investing side. That's a lot of fun. That's where a lot of
It's telling us to request edit access, so.
the one on the left, really?
Really? Wait, what? Is today the 10th?
Yes, March 10th, 26. Is anybody else? Oh, you're still scanning. Thanks. Anybody still need the QR code?
You'll show us how to contact you at the end of this.
I've got cards and flyers
Perfect.
all over the room. Also, that first QR code will work too. Oh my gosh, why is it doing that? There we go. Give it another 30 seconds. Sorry to shoot down your stuff. Try to keep you out of jail. That's my first job. My second job is to stop you from paying so many taxes. All right, I'm going to continue on. Again, feel free to leave if you need to. I get it. We all have busy schedules. Capital gains, and this is probably better on the handout. But a capital gain is when you buy something for a low price, an asset, and you sell it for a higher price, that's a gain. The government wants its piece of your gain. That's a tax, capital gain tax. Okay? So how do you determine how much the gain is? Again, if you want to learn the math, it's going to be here. It's outlined in the handout as well. But essentially, it's the sales price, what you sell it for, minus your basis minus selling expenses. Now, basis is essentially what you bought it for. Any renovations you added to it, less any depreciation you took from it, if it's an investment property or a home office. Okay, I'll just show you a quick example here. You buy something in $200,000 for 2019. You add 25 grand in renovations, and you depreciate it 30,000 over the years. You sell it for 385. What's the gain? There it is. You bought it 200,000, put 25,000 in renos, and 30 in depreciation. There's your basis. You sold it for 385. Subtraction there is $190,000 is the gain. The tax on that gain is not just a straight percentage. Okay, don't assume it's going to be 15 or 20 or 0%. There's a lot more baked into it than you think. In many cases, something of this size, like a property that has this kind of a gain, somewhere around 15 or 18.3%, because there's some net investment income tax in there. Okay, but don't just tell somebody, yeah, it's going to be 15% of whatever that gain is. It's not quite true. I'm actually building an app that you can put in your pocket that you can actually do that math on. It's not ready yet, but anyway, that's your capital gain. So something like this, we can assume 25-ish thousand bucks the tax on that sucker. Again, that's shooting from the hip. Section 121 exemption. That's the nerdy name for the 2 out of the 5 year rule on a personal residence. Okay, so if you live in the property for 24 out of the last 60 months, you occupy it physically, you're registered to vote there, your driver's license has that address on it, okay, you can have an exemption of that capital gain. So if you have in that last example, we had $190,000 capital gain. If you're single and you sell this property, your first $250,000 is tax-free. So you don't have any tax you're going to pay on that property. Pretty nice. Again, you have to live in it 2 out of the last 5 years. Occupy the property. Live there. For personal residences only. 24 the last 60 months. You can prorate this if there's a good enough reason why you moved. And you should find a reason, or your accountant can find a reason if they're really good. We'll find a reason. So if you just live there for 18 months instead of 24, we can take like 3/4 of that exemption. You know, it's possible if they move for a legitimate reason. Like somebody got divorced is one. You changed jobs, somebody died in the family, there's a birth. Like there's, you know, big life reasons. If you do that, you can get away with less than 24 months sometimes. Okay? So nice exemption. So people ask, hey, I'm going to have a $500,000 gain on this property I've lived in for, 10 years. Is that going to wallop me on a tax? Nope. So you get rid of that objection by understanding that. Yeah.
So if somebody bought a house with their spouse, they lived there for 7 years, their spouse dies, next calendar year they go to sell it, is it only $250 because now she's a single filer?
Next calendar year, she has 2 years to be a qualified surviving spouse. So she gets $500.
Thank you.
Mm-hmm.
One question.
If I've got a duplex, I want to convert to personal, stop renting it. In 5 years, does that mean I can get up to 500 very quickly?
Yeah, that's how I would put it. Technically, the rule would be you're supposed to pay a gain based on when it was a rental property, like there's rules there, and then versus when you moved into it, then you exclude that piece of the gain. But I would just take 2 out of 5 years, honestly. I would just take it. Yeah. You can get a half step up in basis.
That's not what
It's not what?
Not worth killing us. They always get caught.
Does he have life insurance? Netflix. My wife loves those murder shows. It calms her for some reason. I don't know. She's plotting something?
She's also very secure and very.
Maybe. She's not here. I'm not going to trash her. Nor would I anyway. Okay, 1031 exchange. If you're working with investors, you need to know what these are. This class, there's a 2-hour class on this one. There's a lot of details to understand. Timing rules, who has the money, who can handle the money, who can't handle it, when you identify, when you buy properties. Anyway, the 1031 exchange is a great way to avoid capital gains tax on commercial use property, including rental properties. Okay, including properties held for sale, even if it's or property for any kind of investment, farm, commercial, mineral rights actually is part of that. Anyway, you can defer or all or some capital gains taxes. You can take a little bit out, but you're taxed on a little bit. A lot of rules. So take a class if you're going to work with investors, or you do, because it's a really powerful tool. If you defer those taxes until death, your heirs inherit your properties. That step up in basis comes into play. So your kids will inherit it. If they immediately sell it, they will have no capital gain taxes on it. Awesome inheritance play. So somebody who bought their house in 1990 for $100,000, and now it's worth 1.3 million, and you die and they inherit it, no capital gain tax. Within 6 to 12 months.
Like they can't live in it, or.
The step up in base is a step up base. So if they keep it and they live there another 5 years, they'll only be taxed on the gain for the 5 years, not the 35. Good question. Okay. Yeah, they could. Mm-hmm. So here's one of our favorite agents, Phil Dunphy. He does 1031 exchange. This is unrealistic because prices are way higher. Property in 2015 for $300,000. It's worth $150 today. If he sells it, he'll have a capital gain of $15,000. That's a super round number. He could owe up to $30,000 in taxes for selling that. If he does 1031 exchange, he follows the rules. 45 days, 180 days. He closes $600,000 for a higher price property. He can defer that $30,000 in taxes. Kick it down the road. Kicks it down the road until death. His kiddos get it tax-free. Pretty sweet.
Oh, they do.
Yeah.
You always have to be buying a better property when you 1031.
Yeah, buy a better property or properties. The purchase price has to be greater of the sum total. There's a lot more rules into that. How many you can buy, what percentages. Take a class on that if you want to. If you have investors, powerful stuff.
If you have multiple people that own a property and they inherit it, it's already in tenants and commons, so they can still 1031. It's just their amount that they inherit. They have to invest more than that, right?
So for 1031s, the entity structure has to maintain the same structure on the purchase and the sale of the next one.
Yeah.
So if one partner wants out and enroll into the next one, it's called a drop and swap 1031. Be super careful with that because it has to maintain its structure and integrity. That's appointment level material. There's a lot of savings in there, but you got to do it right. You got to jump through those hoops, and some of those hoops are on fire. So, okay. Again, take a class on these if you work with investors or want to. This is a powerful tax move. You can even 1031 exchange into like paper securities, like DSTs and Delaware statutory trusts and such. There's ways to stop being a landlord and avoid your capital gains taxes. So if you have investors like, I'm so sick of being a landlord, but I don't want to sell my property because I got to pay taxes, there's ways out of that. Okay. Stay at your house. Sweet. No wonder you don't pay taxes. So depreciation. This is great. It lowers your taxable income, but not your bank account. You can depreciate the building. You can't depreciate land, of course. And then usually it's over 27 and a half years or 39 years, or you can accelerate it. And I'll get into cost segregations in a second, which is where the real fun stuff is. This is magical. This is how I got somebody to qualify for a $600,000 conventional loan with $13 of taxable income. On his tax return. We used his tax returns to qualify it. Flying colors. Because he did a bunch of cost segregations. Depreciation does not count as an expense on a mortgage application. He looked poor to the IRS and rich to a bank. Love it. Okay, speaking of, cost segregation studies are awesome. Accelerates the depreciation on non-permanent building components. So in this building, for example, the foundation, the roof, the walls, the drywall, stuff that you don't like regularly change over short-ish periods of time, that would be a permanent part of the building. Now, when you do a cost segregation, there's a team or a person that goes into the building and they determine how much of this building is what they consider personal property. I hate that name for it, but it's things that you would replace every so often, like carpet, lighting fixtures, interior doors, interior windows, some trimmings count. Landscaping, like fences and driveway stuff, all that kind of work, that can be accelerated. They segregate that out into a little pile. And that amount is usually 20 to 40% of a typical rental property, depending on the property. And I'll show you the math on some of that. If you're going to sell a property immediately after, probably don't do a cost segregation because it's going to come back to you really hard, unless you're going to 1031 exchange it. But fencing, lighting fixtures, flooring counts, alarm systems, appliances, there's a whole list of those. If you don't have enough income to offset it, then it might not be a great move. So let me just show you the math on that really quick. So don't pay attention to all this. Pay attention to this number because that's what we lowered somebody's taxable income by. This is like a $500,000 property. We lowered his taxable income by $115,000. We saved him like $33,000 in taxes with one of these suckers. You can contribute to your HSA and your 401k and all that stuff. This is going to blow that one out of the water. Do all that, but do this too. No, you can do this one time per property. And don't try to sell it back and forth to your spouse. They're on to you. Yeah. You, yeah.
Don't you have to be a real estate professional?
I'll get there. Yes, kind of. There's a short-term rental loophole we'll talk about. All right, great transition. So, benefit of real estate professional status. Let's talk about what it is first and why we care, and then we'll talk about how to get there. You can take losses from rental properties against your active agent commissions. So, if we did that cost seg study, and you made $200,000 in commissions that year, you have $115,000 of expense against that $115,000 bucks, or against that $200,000 commission. So you're taxed now on like what, $85,000? That's a little better.
Yeah. By a rental a year.
Yeah, just by a rental a year. That's that easy, right?
Yeah. You can make us look rich to the bank and poor to the government.
Yep. So take losses against those. Paper losses, by the way, that cost money's not coming out of you got to pay the cost seg company a couple grand, $2,000 or $3,000 bucks. But then they save you a walloping. Pretty cool. So, like I said, if you have $200,000 in commission, $150,000 and less, and paper losses on your rental properties, your taxable income goes down to $50,000. You're in a really low bracket there. So you can get people zero all the time this way. Okay. Now, some people, I don't recommend going to zero all the time because hey, this is the last rental property I ever buy, and I'm still going to do real estate agent commissions. Well, maybe save one of those for next year because that's going to have a greater dollar impact than if we all shove it into 1 year. So if you have multiple properties, maybe think about spreading them out over years versus doing them all in 1 year. Yeah.
How, if you're filing as an S corp, designated as an S corp, and doing this, do those conflict at all, or do they work nicely in?
They work beautifully because your S corp is the S corp business. Your rental property is a different entity. They all end up on your personal tax return. So the loss on your real estate entity, your Schedule E, will offset your income on your S corp at the personal level. That's how that works. Don't hold it in your S corp. Don't hold your rental property in there. Remember? Yeah. Good question.
Now, real estate professional can mean somebody who spends more than 50% of their time.
Yep, I'll get there. That's my next slide.
They can be an investor, not necessarily they'll just look at it like funky if you have W2. So like, oh, how are you spending 54 and 50% of the time?
He's not wrong. In fact, we're going to talk about that right now. How do you get reps? Real estate professional. You don't have to have a real estate license. You don't have to have a contractor's license. You just have to be work that the IRS deems is worthy of what they call a real estate professional. Helping people buy and sell homes counts. So what you guys are doing counts. Building and renovating homes counts. So managing your properties, if you're a property manager, or even if you're just doing it yourself, that doesn't require a license necessarily if you just have your own, right? You can put up, those hours count towards real estate professional status. You have to have more than half of your work, your active work doing those activities though. And it has to be more than 750 hours. It's a pretty high bar. You guys are already over that bar pretty much, unless you're super part-time, right? So you still have to do that. Unfortunately, mortgage people can't do that. Title inspection. They have to be, those specific activities designated by the IRS. Okay.
Somebody who has like 5 to 10 investment properties and is spending a lot of their time during the day taking care of those investment properties, that can count this.
Yeah, sure can. A classic case is an engineer who makes a lot of money. Like they have a $300,000 W-2. They try to claim real estate professional status. If they're full-time engineers, they're working 2,000 hours, right? How many hours do they have to do real estate in order to get real estate professional status?
14 and a half a week.
2,001 hours.
So
because it's more than any other job. That's the high bar for a lot of W-2 people.
a lot of people who are high W-2 earners will have like their stay-at-home spouse
Yes.
do this.
Marry for land and tax benefits.
But I have to say, like, I don't believe that these stay-at-home spouses are spending 14 and a half hours a week on real estate. It's not very realistic for most people.
Yeah,
so are they
that's not for me to judge, but if they're claiming that and they say they have their hours,
they're just
I'm not going to judge.
that they don't get audited.
They look at
Some actually do. If they're working on the
houses.
property a lot too, that counts. Changing the carpet, painting, all that. Usually if you have 3 properties or more, the IRS, lowers your risk level of trying to take this. But if you have a spouse who is not making other income or stay at home or whatever you want to call that, yeah, they can. That's a very common one. That's how we got like a couple of surgeons and CFOs and engineers pull this off. The cost tags on those, yeah, they make like $400K and they're taxed on like 100 of it. It's awesome. Yeah. So marry somebody for tax benefits. And that's my stupid meme. I'm a CPA. I can't claim this. My wife works too. So okay. So even after you clear this bar, you still have to do what's called material participation in your properties. It's not just a real estate professional. You have to actually be working on your properties. The bar for that is 100 hours and more than anyone else. So if you're managing your own properties, that should be no problem. The other one would be like 500 hours if you have multiple properties. You don't care about the 100 each, but that's a conversation you have if you're in that territory. Have a conversation with your accountant.
So if you have properties that aren't local to you, but you manage them, like investment properties out of state,
How?
Well, I manage my Airbnbs remotely.
Okay, well,
like
you
for
got
short-term rentals.
yeah.
I got my license anyway, so I wouldn't have to worry about it. But
Well, you do because you still have to do material participation.
yeah, so you would have to do.
So it's either 100 hours on any one property or 500 hours collectively.
Mm-hmm.
Collectively, the 100 hours has to also be more than anyone else or any other company.
Yeah.
So be careful with that. Okay. Agent who has managed property, that's great. Normally, income is passive. You can't take passive losses against active income. But if you're a real estate professional, that opens that door for you. Awesome. Buy your own product, you guys. My gosh. Okay, if you're not a real estate professional, you can do this. I promise I'm getting there. We're almost done. Short-term rental loophole. This is for people who want to offset W-2 income, with a cost segregation. So there's lots of rules around this one too. So we've had some medical professionals do this kind of thing. The rules are the average stay has to be 7 days or less. Okay, so it's got to be a short-term rental. They call it the short-term rental loophole. 7 days or less. The owner must actively participate in the property. That's material participation right there. 100 hours and more than anybody else and any other company. Okay, so the strategy for somebody who's a high W-2 earner is to close in like October, November, put in their 100 hours. If you're short on hours, go buy your furniture at IKEA. Do that. Took me a second. Thank you. So you do that. You close in October and November. You put 100 hours in there. You don't hire a property manager. Rent it out twice. You cannot have an average without 2 stays at least. Rent it out twice for 7 days or less at arm's length and market rates. Don't refund them after the fact, okay? But if you're audited, they take this one pretty seriously. Okay, if you can do that, then you do a cost segregation. That's how you offset big W-2 income with a rental property. Now, if you decide to convert that short-term rental property into a long-term rental next year, great, you can do that. Okay? But this is an awesome way to really knock down some W-2 income, pay some taxes. Guys, this stuff is going to help you sell more properties. They're not. I mean, the tax benefits alone probably are a bad idea or bad enough reason to invest in a property, but it should be included. It helps make your case. You can take an okay rental property and make it great. I should put this back up in deductions because it belongs up there, but Augusta rule, anybody renting out their own, any property that they own to their own business? Cool. It's the Augusta rule. You can rent out personal residence up to 14 days without tax consequences. You drop a contract between, Dan Mullen LLC or GUFs, whatever, your LLC and your person, Dan Mullen, period, right? You drop a contract, say, hey, I'm going to rent my property out for a reasonable rate. How do you find a reasonable rate? You go on Airbnb, look at houses around you, 3-bedroom, 2-bath. Okay, that looks like mine. $300 a night, cool. $3,000 a night might be pushing it if you live in like West Valley and it's in the bad part of town, right? So it's got to be reasonable. Okay, and you got to document it. Actually have a transaction from your business bank account to your person according to the contract you drop. I'm trying to audit-proof you because this is audited sometimes. Here's how to protect yourself. Just document it. Why are you renting out your home to yourself? There could be a number of reasons. You could have a mini board meeting with your own business, with your board. Take minutes, document it. If you have a nice house and a nice yard, this is an awesome way to do a client appreciation event. I've seen a lot of agents do that. So, and you can do that up to 14 days. Usually people do it 12 and they do like a monthly thing. We're going to do our monthly mini board meeting. Here's the rent for it, $300. The income that you charge to yourself is not taxable at the personal level, and you get a tax deduction on the business level. Pretty great. And take advantage of that. Again, I should have said at the beginning too, this class isn't to teach you how to be a tax professional. It's probably to teach you more on what questions to ask yours. Okay, so I'm not trying to hey, I don't remember that. I know I'm throwing a lot at you, right? Okay, end of the tunnel. Almost there. Qualifying for a mortgage while self-employed. Well, employees are underwritten W-2 and pay stubs a little easier. You are underwritten using your tax returns usually. There's other loans out there like bank statement loans and DSCRs. We know about those, but we also know the pros and cons. I talked about that during the break. But that's the thing. Mortgage qualifying income, not the same thing as taxable income. Using like non-cash expenses like a cost segregation. That makes you look for the IRS and rich to a bank. So it's not necessarily the same. If you have an accountant that knows both sides of this, that would be great. That's all I'm going to say about that for now. Okay? Tax returns are almost always the biggest obstacle in self-employed people trying to qualify, by the way. It's like 65% of the time. It's crazy. Okay. Again, if you're sour on reverse mortgages, I highly suggest you change your mind. I wrote a book about this stuff because I was surprised when I studied reverse mortgages. Anyway, here's how I'm going to save my parents. Probably closer to $90,000 in taxes. Okay, so you have a traditional IRA, and you have $100,000 in there, and you want to pull it out and put it into your bank account. What's going to happen? Here comes, let's see, your marginal tax. Let's say you're in the 24% bracket. Here comes the 1099-R, $24,000. That's going to hurt. That's going to turn your $100,000 into $76,000. We do anything about that? Yes, we got to be proactive. You enroll and you get yourself a reverse mortgage. Oh, aren't those terrible scams? No, they're not. They are in the wrong hands. You get a reverse mortgage, also known as home equity conversion mortgage, and you let it build up interest over 5-7 years ish. You pay that interest out of your IRA there. You're still going to get that 1099-R. Okay, that's still going to do that, but you're going to have this 1098. Anybody get one of those in the mail recently for your regular mortgage? It's a mortgage interest deduction. You have to make payments on those every month for standard mortgages, or else they take your house, right? On a reverse mortgage, you can choose to pay or not, right? You're not going to lose your house if you don't make your mortgage payment because there's not really a required payment. But if you choose to do that strategically, after you've accrued some interest that you haven't paid, when you pay that interest, you'll get a fat 1098 that will offset that 1099. You just got that because you can take money in and put money in and take money out of a reverse mortgage. You just got that money out of your traditional IRA tax-free. There you go. Freaking awesome. This takes years and planning. Like, you can't just get one and just do this, right? You give it some planning. Proactive tax planning is worth so much. But yeah, that's how you take money out of your IRA, traditional IRA tax-free.
10 years before you retire something?
Do this over and over. I do it. I'm getting one the second I turn 62. Okay. I'm upper middle class-ish. I don't care. I'm getting one of these because I'm going to do some cool stuff with it, including this, 3 or 4 times at least.
Other cool stuff you can do.
Oh, don't be started. I have a class on that if you want, and come back.
Will it be in your app?
Sorry? No. I'm building a lot of apps. All right, we're done. I really am. I got an engineer on some of this stuff. He's awesome. My first one is a capital gains one. So how do you give taxes as a real advice as a realtor? You know, unless you're a tax professional. Whatever that is. Delta Airlines. I think I was an adolescent when she came out. I was immediately in love. Oh gosh. She's still probably cute. I don't know.
She's still probably
You can say, as far as I know, you really ask a tax professional. You want to keep your license, all that kind of, right? Okay, I know there's a lot. Let me turn the fire hose off. Any other questions? Well, I got you. One other thing I need to add to my future course, by the way, a great way to mitigate capital gains is what's called a charitable remainder unit trust. That's pretty advanced stuff, but that's a great way to put the kibosh on a giant capital gain. There's a lot of moving parts to that, but there's a lot of options to mitigate those capital gains. So just remember CRUSH, charitable remainder unit trust.
So if we have something like that, we just need to talk to you and have you help us with our taxes.
Yeah.
Okay. Yeah.
Just want to make a comment. There's a lot here that we can give value to our clients with, like as far as like helping them, like as a real estate agent, like hey, like go talk to Dan or check out these things that you can do to save taxes through real estate.
I've helped this last year. I've helped no fewer than 5 agents win listings because I was on their speed dial and I could answer those questions for them. Having someone like that probably good for your team. Yeah.
So if you don't put your investment property in the LLC, what do you do?
You just put them on your Schedule E. Again, the LLC isn't super recognized by the IRS for most purposes. You still record your income and expenses. You don't have to have an LLC to have a business. Yeah.
Where do you house that?
Well, you put it in an LLC, really.
It's not an S corp.
Don't put it in an S corp. Put it in an LLC and then have your trust own that LLC, ideally. Your revocable living trust. All right. Yeah.
So if I have a client that's sorry that they want me to list their property, they fill out my form and there's a lot of like complicated tax strategy questions they have, right? How to offset their capital gains, trigger whatever. That's not my area, so should I
Call them.
Like I
Protect your license. Yeah.
Okay.
Mm-hmm.
All right, sounds good. We'll talk.
I have so many spreadsheets on real estate stuff. Okay. Any other cues that I can add?
Well, are you taking new clients?
Yes.
Okay, good.
If you have an S corp, we're probably going to extend you. We're like 5 days away from the deadline. But extending is not the end of the world, I promise. A lot of clients do it. There's no risk.
I extend like
Yeah. I often do. I didn't this year. But. Thank you, everybody.
Question?
Yeah, appreciate it.